Hey, Rent or Retires, it's Adam Schroeder here with another episode, and I am joined today by Aristotle. He is a 1031 exchange intermediary with Excel 1031, and we are going to talk about the thing that everybody is likely to do as a real estate investor, and that is obviously the 1031 exchange. So, Aristotle, thanks for joining us today.
Hey Adam, thanks for having me. It's great to be here.
Yeah, so most people have heard about 1031 exchanges. They probably have some idea of how it works. Can you kind of do the kind of high level, what is a 1031 exchange? And then we'll dive into more of the specifics later.
Sure, absolutely. So really basically a 1031 exchange is a way for an investor who owns a property that's used for investment purposes. It's a way for them to sell that property and defer their capital gains. And what that looks like is they basically would sell their property and they would take those proceeds and they would roll that into a new investment property equal to or greater in price. And that would allow them to defer their capital gains. And a company like ours, as an intermediary, we hold those funds while you're identifying your new property. Because the moment those funds go into your hand, let's say you close escrow on your relinquished property, the property that you're going to sell, once those funds go into your account, you can no longer do a 1031 exchange. But our company, as an intermediary, we hold those funds so you don't touch them, and that allows you to defer those capital gains, so you don't have to pay those. And there's a lot of other rules which we can talk about with the 1031 exchange, but basically, I guess what I want to get down to is that most investors they typically are going to buy another investment property, right? You see this in your line of work all the time. People want to sell a property and maybe they've owned it for 5 or 10 years or longer, or maybe they inherited a property and they want to buy another investment property. And so you might as well do a 1031 exchange because typically after 10 years, you're going to have a substantial amount of capital gains tax to pay. And it only makes sense to do a 1031 and not have to pay those taxes at the sale of the property.
Yeah, and go over some of the basic rules that there is. Like I know you have to buy a certain amount of property. You have to, you how do you figure out kind of what amount of capital you're going to need to deploy into it? Like let's go with you have a property that you bought for 200,000. Over the years, you've used in your taxes, you've depreciated around 100,000, and let's say you're selling it for 500,000. Can you give us a rundown of kind of how what somebody would have to do?
Sure. So your question is what someone would need to do in order to do an exchange on that kind of property or
Yeah, like what are some
capital
of the
gains?
basic ground rules? Like what are they going to have to likely identify in terms of amount? How much money will they have to, to put into that property? They have 300,000 in gains, but they've also depreciated some. So what are the rules they have to look at whenever they're identifying?
Yeah, so there's really two main rules that you have to keep in mind when you're doing a 1031 exchange. In order to defer up to 100% of your capital gains, the first one is that you need to purchase equal to or greater than your net sales price. So, if your property you're selling is 500,000, the net sales price is going to be the price after your closing costs. Okay, so let's say $500,000 is what it goes into contract for. Let's just say for round numbers that your closing costs are $50,000. That's going to include escrow fees, commissions, transfer tax fees, all that stuff. So let's say now it's $450,000. That would be your net sales price. So you would need to purchase at least a new property of at least $450,000 or greater in order to defer your capital gains tax. Anything less than that, you would be subject to capital gains tax. So the goal is to buy equal to or greater than. And then the second thing would be to take in order to defer your capital gains, would be to roll all of your proceeds from the sale of that property into your new property. And again, anything that you take out or anything that you're short of will be subject to capital gains tax. That's really like the easiest way to remember how to do the exchange. Now, one thing people get confused on is the capital gain question. They say, well, isn't the capital gains what I'm selling it for versus what I owe on the loan or whatever? No, that's not what it is. You actually, Adam, were saying, and you bought it for 200,000, And if you depreciate it down to 100,000, your basis is, that's what you bought it for, is 200,000. You depreciate it for 100,000. And then if you did any kind of improvements to the property, maybe you added a deck or a new roof or whatever, you would add that onto your basis. So whatever your adjusted basis, which again is your what you bought it for, minus depreciation plus capital improvements, that's your adjusted basis. You would then take that amount and subtract your net sales price from that, and that would give you your capital gains estimate. And we actually have some really cool calculators on our website that help people calculate capital gains tax if they're kind of confused or they don't know how to get that number. But it's kind of important to know because sometimes an exchange might not be beneficial for people. And we say that because maybe you've only owned the property for a short amount of time, or maybe you don't have a large capital gain to pay for. And so we do a free cost analysis for everyone who's interested in doing an exchange just to see if it makes sense.
Hey everyone, it's Zach Master, CEO of Rent to Retirement, the nation's leading turnkey investment company. Over 800 of our investors have already joined the Rent to Retirement Academy, where they've learned how to buy their first or next investment properties in 90 days or less. Academy members are averaging 4 properties per year using creative strategies to fast-track financial freedom. We teach you everything you need to know to be a successful investor from A to Z, including private lending, short-term note strategies, how to protect your assets, how to maximize tax benefits, everything you need to know to help you maximize your returns across the board. Plus, Academy members become immediate referral partners where you earn up to $1,000 per property that your referrals buy for life on every investment property purchase from all of your referrals. Last year, we paid over $160,000 to our top Academy referral partner. Our Academy enrollment is closing after the next 20 signups, and right now there's an exclusive 50% discount only available for the next 5 days. To learn how you can join our exclusive Academy program today to fast track your success, click the link below and we'll see you on the inside.
Yeah. So from what I understand, there are three main ways you can do a 1031 exchange. There's the 3 property, there's the, going up to 200%, then there's the 200% rule. Can you kind of go over what each one is, as we go through this?
Yeah. So basically, yes, you're right. They're on the identification side of things. There are three types of rules that you have to choose from. Okay, and when you actually identify your property, you have to choose one of these. So as you alluded to, there's the 3 property rule. This is basically where the taxpayer can identify up to 3 properties of any value. So this is really applicable for, let's say you live in a high price market and you want to buy in a high price market. Let's say, so I'm in California, for example. If you saw a property for $1 million and you want to buy another property for equal price, you're not going to be able to purchase any more than that typically. But if you're going to be going out of state, like with your company, if you're going to be selling in a high price market and buying 2 or 3 in, Alabama or Tennessee, wherever, that would certainly apply. But let's say you want to buy more than that. Let's say you have a lot more proceeds and you want to purchase more, maybe 5 or 6 properties, then you'd have to select what's called the 200% rule. And that means that you can identify unlimited number of properties, provided that the total fair market value of the properties does not exceed more than 200% of what the sales price is on the relinquished property. So let's say, again, $1 million property you're selling in California. You can go outside and buy several, 4 or 5 in Alabama, for example, as long as that total price does not exceed 200% of what the $1 million is. And so let's say you sell it for $1 million in California, you can't buy more than 200% of that. So, and then the last rule is a 95% rule. This is kind of a rule that most people do not select. The 3 property rule and the 200% rule are the ones that most people select. The 95% rule says that if you identify properties that's in excess of both the other rules, meaning that it exceeds the 3 property rule and the 200% rule, then you have to acquire 95% of the value of all the property identified. That's a little tricky. So most people don't select that one. The most common one is the 3 property rule and the 200% rule. So
90% of real estate investors miss key tax savings by overlooking deductions. Flipping houses, managing rentals, or growing your real estate empire? Make sure you've got experts in your corner, especially when it comes to taxes. That's why we turned to Nevada Corporate Headquarters, the experts who help us reduce taxes and set up our real estate LLCs. With 35 plus years of experience and 17,000 five-star reviews, Nevada Corporate Headquarters helps you manage properties across states, navigate tax laws, and protect your assets, all with a real estate LLC. Visit nchinc.com/RTR to schedule a free real estate LLC formation and tax consultation. Plus, receive a free guide to safeguarding your assets.
Not every real estate investment model is the right fit for every person, and that's okay. Do you want real estate returns without tenants, toilets, and 2 a.m. calls? Ignite Funding investors earn 10 to 12% annually, completely passive. At Ignite Funding, we fund commercial real estate loans, and you become the bank. That means you earn interest every month backed by real property. Call Ignite Funding at 702-739-9053. That's 702-739-9053. Let's put your money to work.
So one of the things people really worry about as well, whenever I'm talking with them and, the other strategists are talking with them is, well, let's say I have this 1031 exchange. I identify, 4 properties that are going to do it. And for some reason, one of them doesn't close and they think they're going to have to pay tax on everything. Is that true?
No. So if they're worried about paying tax on everything, like you would blow your 1031, no. But the key is to identify enough property that's going to cover what you're going to be exchanging. For example, if you had a $1 million property that you're selling, you want to at least identify 3 properties are going to, or up to 3 if you're going to choose the 3 property rule, for example. You would want to choose at least up to 3 that are going to tally that. Now, if there's one, let's say you're identifying, you just need to identify 1 or 2, then you can identify a third one using that 3 property rule, right? And then hopefully, 1 you'll get accepted. The really nice thing about the one thing I really love about your company is that you guys have a lot of options for properties, right? Like there should be no issues being able to identify properties with rent to retirement. So you guys have a lot of options for people in different markets. But going back to your question, if they have 4 properties and the one fails, and if they still meet the requirements, then no, they don't have to pay capital gains. But if for some reason they're not equal to or greater than their net sales price with combined prices, or maybe they didn't use all the proceeds, then yes, anything less would be subject to capital gains tax. So, if you know that you're going to identify, or that you're going to be purchasing at least, like, let's say 4 properties, then you'd want to do the 200% rule, because then maybe with your company, they can identify an extra 1 or 2, right? And then if for some reason they decide to back out of one or whatever, they still are going to be able to fulfill their exchange. The tricky part is identification timeline, which what we can talk about here, I guess. But you have 45 days, calendar days, to select the identification rule and identify your properties. The day that you close escrow on the relinquished property, 45 calendar days. It freaks people out a lot, right? They're like, "Wow, I'm not going to have a lot of time to identify." It's actually quite a bit of time, and it is. I would say it's not very common that people can't find property. But again, with your company, it's great because you have so many options. If you were going to go the traditional route and just use a real estate agent and make offers on properties, that could be a little bit daunting, but your company makes it really easy to identify stuff.
Yeah. Yeah, you say that it's easy to do that, but I had somebody call me just yesterday and say, "Hey, I need stuff by Friday because I keep getting all these notifications from my intermediary, and I guess I really need to get on that." So it's 45 days can go faster than people think if because life gets in the way. So let's go over that timeline. You mentioned the 45 days, but that's just to identify. There's 2 other mile markers people have to hit. And from, they run concurrently. So tell us a little bit about, the 90 day and the 180 days and what you have to accomplish in that time frame.
Well, there's only two main dates you have to remember. It's the 45-day identification period and then 180 days to close on the property. Those are the two ones. And they both start the day that you close on your relinquished property. So if you closed and your property was recorded today, then you would have 40, the calendar, I should say the clock would start ticking today for the 45-day identification period. And then you also have 180 days from today to close, which is roughly 6 months to close on those properties. Ample enough time to close generally. But yeah, the 45-day identification period can be a little daunting to people. One thing I would say real quickly, and I think Adam, you and I spoke about this before last week, but there is a, I'm going to say a fail-safe mechanism, but if you for some reason have funds left over, let's say you have $100,000+ left over, and you just can't identify your last property, and you're like, oh my gosh, like I have like a week left, I have 5 days left, I don't know what to do, and you don't want to pay capital gains on the $100,000 that you still have left over in the proceeds, right? So you could do what you could put that money into what's called a DST, which is a Delaware Statutory Trust. Basically, it's where you own a fractional, it's fractional ownership of maybe a larger commercial property. We have a couple partners that we work with here. Won't go into depth on all this stuff necessarily, but get too technical. But basically, it is a way. It's a really fast way to be able to put money into something in a 1031 exchange vehicle, not have to pay capital gains tax on that, and again, just be able to meet your deadlines and meet your capital gains deadlines. So that is a mechanism. We have people that do both. We have investors that will identify properties and then they'll put a little bit of money into a DST. DST it's a passive investment, so there's no maintenance, there's no management, there's no landlording, no property management. It's all taken care of. So we have people that do both, but that is a last resort. So if you really can't identify anything and you just haven't come to that term, then DST you can identify something within a day or two and get it wrapped up really quickly. So it's very fast.
Is that something you can do? Like, let's say we had that $1 million property, so we have up to 2 million to do. Could I identify like 5 properties that are 1.5 million and then just say, you know what, I'm going to add 450K of potential DST to kind of fill that gap? And then if one of them fails, do I have to do the full 450 with the DST, or could I do part of it? Kind of how would that work?
You can split it up however you want. It's the same thing with types of properties. People think, okay, if I sell a single family home that's an investment property, I need to purchase another single family home residence or residential, and you don't have to. You can purchase a commercial building. We have clients that will sell a single family home residence and they'll buy a small medical building. So you can really identify and mix and match however you want. So yeah, for some reason you've identified several properties, but one failed or one you just want to discard, and you want to put more money into a DST or some other 1031 property. Absolutely, you can do that. You can mix and match as long as you're meeting your the equal to or greater than net sales price, and then you're using all the proceeds. That's kind of all that matters.
Yeah, fantastic. And so you've got that 180 days, you've closed, you have the properties. The question that I wanted to throw out at you is how long? I mean, some people think, well, I can just 1031 exchange into it, and then if I'm trying to get the capital, then I'll just sell it in a year, and then I'll have a different basis, and then I can kind of skip out on taxes, but pay a little bit on that one instead. What are the rules about holding afterwards?
Yeah, it's a great question. So the IRS doesn't really have there's a lot of is a gray area with 1031 exchanges. There's no set deadline. There's no time frames on what they say. Hey, you need to hold the property for X amount of months or years. However, most accountants and CPAs will say, in order for you to 1031 a property or for you to be eligible, you need to have at least 1 year, 2 years is better of that property being a rental property, meaning that you're claiming it on your income tax return. So 1 year there is minimum 2 years is better. So if you were to purchase a property, 1031 exchange into a new rental property or a property that qualified for the 1031, it should be held for at least a year. 2 years is better. Again, there's no time frame on this, but usually they're going to say 1 to 2 years is better. The shorter that you hold it, then the IRS thinks that you're a dealer. I mean, like you're trying to flip the property or things like that. And that's where you could get audited. And audits are random, right? But you don't want to get audited and have to explain yourself and deal with all this stuff. And it's just a pain in the butt. So yeah, 1 to 2 years. And we actually have people that maybe they've owned a rental property for a long time and they want to do a 1031 into something where maybe they want to retire to in like 5 years or 3 years. That's totally possible. There's no reason why you can't do that. So let's say you want to retire in Hawaii in 3 years, but you have this rental property in Texas or in Arizona that you want to sell. You can 1031 into a property in Hawaii, have it rented for, let's say, 2 years as a rental property, and then move into it after that. And the IRS is not really, they're not going to really care about that. But you just don't want to cut it close and move out to Hawaii like in 6 months or a year after you did a 1031 exchange.
Okay. And what about whenever you're doing the 1031 exchange, do you have to only use your 1031 exchange money, or can you bring in, outside capital of your own? And kind of is commingling funds okay?
Great question. You can definitely add your own additional capital. So if you need an extra $30,000 or $50,000 to put down on a property, you can absolutely use your own money. That's completely fine. That's called boot, and that's completely allowed to do that.
Okay. And so what you kind of touched on it a little bit, but when do 1031 exchanges, like whenever you talk with people and they come to you and say, I want a 1031 exchange, what are the most common reasons that y'all would tell somebody, yeah, you don't want to use us, you don't want to do this? When are those situations?
Yeah, that's a great question. Well, definitely if you're flipping property, you cannot 1031 on a flip. People get that confused all the time. If you're flipping properties, that's short-term capital gains. And again, the IRS looks at that as your dealer, you're flipping properties. So that's not allowed. We also have maybe you don't have much of a capital gain because the 1031 fees, the exchange fees, like and our fee is very minimal. It's very inexpensive to do a 1031 exchange. But if you've held the property, here's another scenario. Let's say you had it for a rental property, but then you moved into it and you lived in it for the last couple of years. Well, in the United States, you're able to take the homeowner's exemption. I don't know if you're aware of that. So you have the exemption, which allows you, if you're single, you're exempt up to $250,000 of capital gain, and if you're married, it's $500,000. So let's say you were married and you had a rental property, and then you moved into it and you lived in it for 2 out of the last 5 years. Well, depending on how much capital gain you have, you might not need to do a 1031 exchange. You can just sell it and use the homeowner's exemption option on that, and so you don't have to do a 1031. So that would be another reason. Or again, maybe you only held the property for 1 year and you don't have much of a capital gain. Maybe you didn't take any depreciation, or maybe it hasn't appreciated much. Maybe you bought it in a market where it didn't go up much, and you bought it for the difference is very marginal. That could be another option why people would not want to do a 1031 exchange. Yeah.
Okay. And what is the reason you do a lot of these? Obviously, the vast majority of them succeed, but some people are going to likely fail along the way. As someone gets started on these, what are the pitfalls that you've seen that lead to people not completing their 1031 exchange?
Ooh, yeah. I would say really it's just I mean, so we're here to help you make sure that you're following the guidelines, right? That's the biggest thing. And we do everything we can to every 5 days we send your identification form to you. Hey, here it is. And I'm always on the phone when people are getting near their 45-day deadline if I didn't hear from them. So we do our best to make sure that you are not going to miss that 45-day identification window. Because I think that would be I've heard that a lot in the industry where exchangers or investors selling property, they didn't really know when their 45-day window was up, or their intermediary didn't really alert them of that. And I would say that's not good customer service. So we want to make sure that you don't miss that deadline. And then also, like, working with a company like you guys. I mean, the fact that we can refer investors to you to identify properties. I mean, you guys have so many options that are ready to go, and new construction that can close in 30 days, right? And so we have lots of options for people to do that. So I would say, if really, if it failed and we did everything we could, it would probably come down to just either, maybe you just totally forgot about it, which I think that could probably happen. You totally forgot about your exchange. Maybe you went on vacation for a few weeks or something, and then all of a sudden it's already 45 days and you missed it. Or maybe you were just making offer after offer after offer and you weren't getting anything. But again, there's that DST option, which some people like that. That would be like a last ditch effort to do that. And then there are some people who just say, you know what, I changed my mind. I don't want to do a 1031. I'm just going to take the tax hit. Some people are okay with that. I mean, I don't know if you know, Adam, but the capital gains tax can be up to 40%, depending on what your income bracket is and what state you live in. I live in California, and so we have a very high income tax. And so if you are making really good income out here, and you're kind of on the top, and you have to pay up to 40%. Imagine if you had just $100,000 gain, you could almost have to pay $40,000 to Uncle Sam, just in not doing a 1031 exchange. So, but yeah, it happens. Some people just change their mind and say, you know what, I don't want to buy investment property anymore. We just want to take the cash and pocket it. So, but yeah.
Most investors are sitting on capital and don't even know it. If you've owned your home for a few years, odds are you've built up equity. With Figure, you can put that equity to work, funding your next property without touching your low-rate mortgage. It's called a HELOC, but not the old school kind. Figure's platform is tech-forward, digital-first, and investor-friendly. You apply online, there's no in-person appraisal, and funds can be available in a matter of days for eligible applicants. Visit the link in the show notes and see how smart investors are using equity to accelerate their financial freedom. Equal housing lender, terms and conditions apply. See site for full licensing and disclosures. Ready to level up your real estate investments? Blueprint Home Loans simplifies property financing so you can focus on building wealth. Whether you're buying your first rental or scaling your portfolio, their expert team delivers tailored solutions, nationwide reach, and a seamless, stress-free process. With decades of experience in creative financing options, Blueprint is the partner you can trust to fuel your growth. Schedule your no-obligation strategy call today by calling 888-343-1043 or go to the link in the show notes. And let's build your success story together. Have there been any big changes to 1031 exchange rules in the last few years? Have you heard of anything that people are kind of discussing? I know there's a lot of tax things going on in the world about accelerated depreciation. There's a lot of discussions in Congress about tax breaks and all of that. Have you heard anything out there at all that leads you to think there's a possibility that things might change either for the better, for the worse, or anything? Or is it just kind of something that it's set, politicians don't really talk about it, it's not likely to change?
Yeah, that's also a great question. There's always talks about government getting rid of the 1031 exchange, and I don't see how that would benefit anybody in this country. I don't. So no, there hasn't been any changes to that. They've been talking about that for a long time, but who knows? I mean, our new administration has been doing stuff that people haven't thought that would ever happen before. So there's lots of changes, but I don't. There hasn't been really any talk about that 1031 exchange going away. There hasn't been really any updates. There now that we're seeing more and more natural disasters, forest fires and floods and all this stuff. There's this isn't really new, but there are extensions that you can qualify for. So if you are ever affected, it depends on what time of the year, of course, this happens, but if you're affected by a wildfire or a flood or something like that, and either your property that you're selling, you're doing a 1031 exchange is in those areas, or you live in those areas. For example, up in California here, up in LA, when we had these fires in the beginning of the year, if you lived in those areas, LA County, and you were doing an exchange, doesn't matter where it was, whether the property was in California or somewhere else, you were allowed an extension. It's a 120-day extension. But you look at when that was going to happen, because if come April, which is tax time, the deadline, I think, was either 120 days or October something. I don't remember the exact date, but it was either 120 days or the date of October is when you have the extension for. So keep that in mind if that ever occurs to anybody. That is kind of a thing. And IRS they post those extensions on their website all the time, but no changes as of now. I would say that the thing I heard recently was in New York. So there's something called a drop and swap. Have you ever heard of that before? Yeah, so drop and swap. So this is when it comes to 1031 exchanges, and again, I won't go down a rabbit hole too much, but I love talking about this stuff. But with the 1031 exchange, title is a really important factor, okay? And what I mean by that is whoever is on title of the property that you're selling. So if you are on the title of that property, then you must be, as a taxpayer, you must be the person purchasing the new replacement property. It's pretty simple. But sometimes maybe you're partners, and maybe one of you wants to do a 1031 and one doesn't want to do a 1031 exchange. Well, you think it'd be easy as just like, okay, well, let me just remove myself from the title before you do a 1031 exchange. The IRS does not like that at all, and that's a huge red flag. And it's mostly California. They don't like that. Other states, they're okay with dropping, but in California, for example, they frown upon that. But there's a court in New York that just passed. I wouldn't say it's a bill, but they basically said that, hey, it's okay to do that. It's okay if one person wants to drop off right away, and you can 1031 the property. In California, you have to wait. Generally, it's like a year to 2 years before you can sell the property. So let's say you and I own an investment property here in California, and I wanted to do a 1031 and you didn't. You could deed yourself off that title, but then I'd have to wait like a year to 2 years before I can do 1031. Kind of a pain in the butt. But New York is kind of like California, so hopefully those laws will rub off in California at some point.
Right. And so I'm looking to do a 1031 exchange. I know I've got equity in the property. I know I'm going to qualify for it. When is the time that people need to start contacting intermediaries? And does it impact your offer at all? Like, do you have to say, here's a pre-approval and here's my intermediary or something like that? Does it impact the purchase process at all, other than the funds go to you instead of to me at the close of the sale of my owned investment property before I go and buy the others?
Great question. We're all about education here, and I've been educating investors and for many, many years. And so if you need that handholding before your property even goes in the market, let's say you're going to, you know that you need to do a 1031, maybe your accountant told you need to do one, or you contacted us and we ran through some capital gains questions, and we said, yeah, you're going to have X amount roughly to pay if you don't do a 1031 exchange. We want to make sure that you're educated and you understand the process before you even sell the property, because it can be a little confusing. But technically, you don't have to set up an account with us until your property that you're selling, your relinquished property, is in escrow or in contract. That's when you would set up an account with us at that time. So, but it is wise to choose and talk with an intermediary if you've never done one before, because it can be a little complicated. You want to know what kind of properties you're going to have to identify. That way, you're not just like, okay, like I'm rushed, I got to do this right away. Just give yourself time to do that. And again, with your company is great, because someone can contact one of your investment counselors or and just say, hey, I need to identify 3 properties, and what would you recommend in this price point? And so that's all really needs to happen. But yeah, it's pretty simple. I would say definitely talk with an intermediary. I would say have that lined up. Have that lined up, at least talking to somebody before you list your property. That way you're completely understanding the rules and the guidelines.
Yep. And then double, triple, and quadruple check with title that they're going to send the money to the right place. Because
That's right. That's
I'm
right,
guessing
yeah.
even if title messes up and sends it to you, and even though they were supposed to send it to y'all, it just ruins everything.
Well, I mean, not well, it depends, but I mean, I don't really see that. I mean, so when you open an account with us, you get your own account with the bank that we're with, and so you have your own exchange account in your name, which is great, and that's important to have. We're fully insured and bonded, and of course, the account that your money sits in is FDIC insured. But yeah, we work with title and escrow to make sure that all the funds and everything are the correct amount. And it's important for you to know how much roughly you're going to get from the sale of your property too. That way, hey, I need to buy one property or I need to buy 3 properties. So
Yeah, fantastic. Well, Aristotle, thank you so much for joining us today. Give people, the website you want them to go to, or any contact information you want to hand out. And then if there's anything else, that I haven't asked about that you think are important for people to know, just run through that as well.
sure, yeah. So I appreciate that. Our website is excel1031.com. So it's EXCEL 1031.com. And we've got some great videos on there, resources. My cell phone number, I always have my cell phone on. So if anyone wants to call or text me anytime, it's 310-467-8122. You can always reach me there. Happy to answer any questions, go through capital gains scenarios with you, or talk with you about the process. I would say, just to sum it up, yeah, I mean, you have lots of options when it comes to 1031 exchanges. We didn't even talk about the kind of exchanges, because we also offer reverse exchanges and improvement exchanges. A reverse exchange is basically where you just do the opposite, where you buy a replacement property first and then you sell your relinquished property. We do those. We do work in all 50 states. But I would say, yeah, talk with, we're not CPAs, we're not accountants. We can't give you legal advice, but we do know that the IRS tax code regarding 1031 exchanges, and we do know how to calculate capital gains, et cetera. So, but if you have any accountant questions or things like that, definitely reach out to your accountant or CPA first. But yeah, we're definitely happy to help you with all this stuff. But yeah, that's really about it. Just contact me if you guys have any other questions or I can be of any help.
All right. Well, fantastic. So if you want to see some of these properties that Aristotle's been pumping up, you can head on over to renttoretirement.com. That's renttoretirement.com. Our inventory is right there. You can schedule a time with our strategist to talk about your plans. And if you have any questions you want us to relay on to him, or if you have questions you want me or Zach and myself to answer in future episodes, or if you want to come on and tell your story about your investment journey, email podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. Really appreciate the time y'all spent educating yourselves today. Talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.